Welcome to the Rim Break Rodeo. We hope this video helps.
The accounting equation states, assets equals liabilities plus equity, and it must always balance. Assets are resources a business owns, like cash, inventory, and equipment. Liabilities are obligations such as loans, accounts payable, and taxes payable. Equity represents owner claims and equals assets minus liabilities at any moment. For example, assets 0, 000 equals liabilities 0, 000 plus equity 0. 000 shows parity. Always read the equation left to right to confirm the company's financial position and to explain why every transaction affects two sides. Every transaction affects at least two accounts, so the equation remains balanced. This is the principle behind double-entry bookkeeping. If you buy equipment on credit for 000, assets increase and liabilities increase by 000, keeping assets equals liabilities plus equity intact. If the owner invests 5,000 in cash, assets increase and equity increases by 5,000. Paying a 000 liability reduces cash and liabilities equally. Recording sales and expenses changes assets and equity through revenues and expenses, which flow to retained earnings. Net income increases equity, while owner withdrawals or dividends decrease equity, so track profits and distributions carefully. To analyze accounts, prepare a trial balance to verify that total debits equal total credits, and therefore the accounting equation holds. Retained earnings reflect cumulative net income minus dividends and updates equity each period. When expenses exceed revenue, equity falls. When revenue exceeds expenses, equity rises. Regularly reconcile bank statements, review ledger balances, and confirm assets equals liabilities plus equity after every closing cycle to ensure accurate financial reporting.
Thanks for watching. Consider subscribing if we helped you.